Do you want to invest but don't know where to start? Today I'll explain the simplest method used by millions of people: index funds. You don't need to be an expert or guess which stock to buy. I'll tell you with easy examples and a step-by-step plan. What problem do they solve? Investing by hand is exhausting and frightening. Apple, Tesla, banks, energy. Index funds take that worry away. You invest in many companies at once, without choosing one by one. Analogy, it says, like a tasting pack. You get to try a little bit of everything without having to stick to just one flavor. What is an index? An index is a list of companies that represents a market. Example, S&P 500. US majors, MSCI world majors from many countries. Local indices, your country region. An index fund copies that list. If the index rises, your fund tries to follow it as closely as possible. Index fund versus ETF. Traditional index fund. You buy it directly from your bank or asset manager, and it usually allows for automatic monthly contributions. ETF, it works the same way. It tracks an index, but it is bought and sold on the stock exchange like a stock. For a beginner, both can work. Choose the one that is easiest for you to automate and has the lowest fees. Why do they like them so much? Automatic diversification. If one company does poorly, others compensate. Low fees, you don't pay a manager to predict the future. The fund simply tracks the index. Simplicity, you don't get married to a single action, nor do you check the news every hour. Long-term mindset, perfect for those who want to save and invest without complications. How to get started step by step. Step 1. Prepare the ground. Have a cushion 3 to 6 months of expenses. Avoid expensive debts, credit cards, high-interest loans. Step 2. Choose platform. A regulated bank or broker with low fees allows automatic contributions. Step 3. Choose the index. To start, simple. MSCI World, ACWI. Many companies from several countries, very diversified. This is ... S&P 500. America's big players. Simple and very popular. If you want something local, add a small percentage of your market. Step 4. Background type. Accumulation. Automatically reinvests dividends, grows on its own. Distribution pays you cash, dividends collects. But you manage. Choose accumulation if you want to grow without mess. Step 5. Periodic contributions, DCA. Choose a fixed amount each month, 50 euros, 100 euros, 200 euros, whatever you can afford. Schedule automatic charges on the day you get paid. Don't try to guess the best time. Consistency is the norm. Step 6. Define your mixed stocks, bonds. If volatility bothers you, add a bond fund to smooth out the ups and downs. Examples of indicative mixes: choose the one that lets you sleep. Conservative, 60% stocks, 40% bonds. Intermediate, 80% stocks, 20% bonds. Aggressive, 100% actions. Rebalance once a year. Return to your target percentages. Sell some of what has risen the most and buy some of what has risen the least. Realistic expectations and risks. The stock market goes up and down. There will be very good years and bad years. If you need the money in less than 3 to 5 years, don't put it in equities. The important thing is not to choose the perfect day, but to maintain the habit and not panic sell. Common mistakes. Change your background every month to reflect the news. Solution: define your plan and be patient. Having too many funds, 10 funds doing the same thing. 1, 2, 3 well-chosen funds are enough. Ignore commissions. A high commission costs you a lot over the years. Invest money you'll need soon. Keep that money out of the market. Quick questions. Is it a good time to start? The best moment was yesterday. The second best is today. The important thing is to start small and be consistent. Could I lose everything? In global funds, you're spread across many companies. The total risk is lower than investing in just one. Even so, the value can go down. Invest wisely and for the long term. And taxes, they vary by country. Do your research before you start. Many funds and ETFs are already tax efficient. How much do I put in per month? Whatever you can afford without getting overwhelmed. A steady 50 euros is better than 500 euros a month and nothing the rest of the year. 7-day starter plan. Day 1. Review your budget and set a monthly amount. Day 2. Open an account on a regulated platform. Day 3. Choose index MSCI World or S&P 500 plus to find whether to add bonds. Day 4. Choose a low commission accumulation fund. Day 5. Schedule automatic contributions on the day you get paid. Day 6. Create an annual rebalancing reminder. Day 7. Done. Don't check the price every day. Check once a month. Conclusion: index funds are the simplest, cheapest and most straightforward way to participate in economic growth without going crazy tie picking. Start small, be consistent, and let time do its work. Tell me in the comments which index you plan to choose. Like, subscribe, and tap the bell for more easy guides like this.